I'm Keith McCullough, and welcome to another Real Conversation. I'm with Troy Aikman today.
Thank you.
Yeah,
it's great to be here.
It's good to see you, Troy.
I appreciate it very much, Keith.
So what you were just saying, the Uber guys?
Yeah, the Uber driver was started off my day right by saying, "Wait a second, you're not Troy Aikman, are you?" So that was, it's a nice start to the day. Given that I've lost like 75 pounds from my peak, makes me feel a lot better that people think I'm a former professional football player as compared to like a Bulgarian weightlifter or something.
That's a big rate of change decline, man.
Dude, it's a full bear market, yeah.
Yeah, it's a full bear market. Well, Mike Green, for those of you that don't know, Mike Green is the guru when it gets to options flow. We're going to spend a lot of time talking about what we call options gone wild, but thanks for making the time.
Oh, it's a real pleasure, Keith. I'm glad to be in the studio.
It's cool. Let's start with going back to a very important day, at least according to me.
Yep.
June 15th, which was the day before epic options expiration.
Yep.
So that was, correct me if I'm wrong, I think it was the biggest day of call buying in the history of call buying. It was also, if you look at this market up, VIX up, just to simplify, spot up or vol up, you'd have to go back to two specific dates, which were February the 2nd after the January rally, and a month-end markup, and then back to November, I think 5th of 2021. Which was right inside the leather of all-time highs for Bitcoin, everything from Bitcoin to the NASDAQ to the Russell 2000.
Right as we made the very final highs in the NASDAQ, basically, yeah.
Yes, so those three dates really matter to somebody who looks for the particular in cycles or fractal patterns. But at the risk of saying what I see, because nobody really cares, I mean, it's what you saw that I really care about.
Well, I think we saw exactly the same thing, right? Which is basically a market that is reacting to FOMO, right? The fear that it's going to run away from it by buying the cheapest option protection it can to the top side, right? And that's it manifests itself as a demand for call options, right? As you highlighted, and that naturally gets priced, right? So implied volatility, the VIX rises, driven by the call side of the equation. You see that evidence in terms of the demand when that's coming through. And so you get the unusual environment of VIX up, S&P up, right? Usually they're negatively correlated. They tend to go in the opposite direction. And in this case, it's getting pulled up. Now, the thing that becomes so interesting about that, though, is it's somewhat of a self-fulfilling prophecy, right? Because when you go to buy the call option, you're not actually buying it from me. You're buying it from a dealer, right? And this is one of these things that we keep hammering across various mediums, this idea that when you're buying an option, for the most part, you're not facing somebody on the other side of it who happens to be selling that exact same option with that exact same strike. You're dealing with a dealer who's providing you with a synthetic exposure, right? So they will sell you that call option, and then they'll go into the market. It's really done simultaneously and actually kind of before you even execute. They'll go into the market to replicate that exposure by buying the delta adjusted equivalent of the futures or the underlying stock, right? And so when they do that, they actually put upward pressure on the market. You show up to buy the call option, they have to hedge. It's the exact same process of somebody going in. The difference is you may actually be saying, gosh, I really hope I don't overpay for this thing. I don't really care. They've already sold you the overpriced call option, right? All they want to do is be hedged. Right, so their demand effectively to go in and buy this, and it contributes to the sort of behavior we saw on June 15th, which happened to be my birthday, by the way. And
what a day!
What a day, exactly.
All-time highs.
All-time highs. And so, what you're actually seeing in that event is the market being pushed upwards in this kind of exhaustion move. And at least for now, that looks like that's exactly what that was. That it was that final move where people are like, man, just make sure that I make it through tomorrow okay. That's all they cared about.
Well, I mean, I always try to take people back to the full investing cycle, right? I mean, the market top was November the 8th of 2021. This day happened 3 days before that on calendar days. I mean, the mother of all squeezes in profitless tech to anything that you could have looked at, U.S. retailers as a basket was down 20% by May from that January 2023 lower high. I mean, these are really big moments where you can make a really bad decision, from an investing perspective. And I get, you and I get it. I certainly get chirped. Like that's where my, tweetometer is at its peak, in those moments of time. But really, when you look back at them, it's like a different component of the game that you and I have had to evolve and understand towards. But it's not something that's different in terms of bad behavior, chasing tops puking at local lows or anything like that.
Well, and all of that behavior, like we understand why it happens, because it happens to you and I as well, right? I mean, I'll sit there with a portfolio that I've constructed for an event or a particular outlook, and if it starts moving in the opposite direction, I have to start considering, all right, maybe I'm wrong.
Yep.
All right, what can I do to inexpensively protect my portfolio against this? It's just when you see that type of event happening on a market-wide basis, you know that that's, you know, like you can always be wrong on this sort of stuff, but when you see that sort of behavior, your incentive should always be some variant of, I know why people are doing this. They just want to make it through the next day.
Yeah, that I mean, for me, I mean, that's a big deal, and I've tried to make this point because, you know, back to the prior point, like I want to know what Mike Green sees when he looks at a market.
Yeah.
I know what I look at when I see a macro market. I don't see commodities, currencies, credit, subsector exposures, including banks to retailers to industrials to, you know, name it. Those aren't doing what that index is doing on Qs or SPYs.
Well,
you know, and it's like a very interesting, because that is anomalous, by the way, versus prior crashes or cycle peaks that we have experience with.
So this is one of the things, I mean, for me, I think you know enough of my background, but like I started as a small cap value guy, right? So like, you know, if I think about how far I've come, I mean, from a valuation expert coming out of, you know, undergraduate with a degree in finance and building a company that was focused on equity valuation and doing the discounted cash flow analyses and actually caring about the corporate earnings. Today, when I look at the market, like, man, all I see is like various forms of flows into ETFs or sector ETFs or indices, et cetera. And then you're watching, or the options, as we're talking about, right? These mechanical flows that are created by people effectively trying to avoid doing the work of investing, right? And we're all guilty of it, right? Like nobody actually wants to sit down and spend 72 hours building a DCF model, particularly if nobody cares, right? And it really feels like that way, unfortunately. Like there's a lot of, you know, decorations that are put on stuff with sell-side research, et cetera. But the simple reality is like once you start saying, okay, NVIDIA at 200 times earnings, or, you know, 21 times sales or whatever, like you've moved far beyond anything resembling financial modeling, and you're basically putting a finger in the air and saying, you know, some form of relative valuation, and why could you buy this, right? Mm-hmm. So like talking to Mike Taylor, who, you know, you and I both spend a disproportionate amount of our time, you know, trying to explain to him how markets work. That was a joke, by the way, but you know, Mike has an unbelievable point on something like NVIDIA, right? Which is, if I look at most fund managers who are required from a regulatory framework to not be overly concentrated, right? So a 40 Act fund has to carry a certain level of diversification, with some exceptions. We can come back to that. They can't get overweight Microsoft. They can't get overweight Apple, right? Mm-hmm. They're so large in the index that they actually couldn't do it. But you know what they could do? They could get overweight NVIDIA because it was small enough. Yeah. Right? And so you saw money piling into this sort of stuff, and then of course the narrative gets built around it, right? And more than anything else, that's what I see is when I look at markets, it's almost like I'm constantly got a little smile on my face because I hear all these explanations that to me are the equivalent in many situations of, you know, well, the sun transits the sky, you know, driven by a golden chariot, right? It's like most of this stuff is really just mechanical flows.
Well, that's a really good point, and I was just trying to listen to what you were saying when you're making a very good troglodyte joke, by the way. I hope Mike T's enjoying this. Mike Taylor, by the way, shout out to him. But Mike's very good, in fact, world-class good, at giving you behavioral flow.
Yep.
This is what a PM, exactly what you just said, behavioral flow. And there's quantitative or mechanical flow. Right. So let's use an example that my inbox is infiltrated right now with what is the JP Morgan hedged equity fund going to do into the quarter end? Because they have something like 40,000 SPY contracts at 43.20, I think is the strike.
Yep.
So that, like, I wouldn't, when I was running my fund, or by the way, of 15 years of running Hedgeye, I never had to deal with that. But that's something I got to deal with on Friday.
Yeah, no, it's funny because so Mike and I actually bonded on a lot of these topics. If you talk to Mike about like where there was a sea change in his investing framework, it's when he recognized that he could actually figure out what people were going to be forced to do.
Yes.
Right. So he started caring about the flows. He didn't care about, you know, what was the actual announcement coming from this drug company. He cared about how were people positioned going into it and what would they be forced to do. Mm-hmm. Right. And the minute he started doing that, he moved from being amazing to world class.
Mm-hmm. Right? I agree 100%.
For me,
a lot of people haven't, by the way. I've seen a lot of people go from amazing valuation intellects, I'll call them, our former selves, And some people get upset because I call them, like whatever, valuation or spy monkeys. It's like, no, that's what I used to do. That's what you used to do. You're a small cap
100%.
value stock picker. I was a consumer stock picker.
Yep.
We would start with valuation. That was our North Star. If you're still doing that, you're either a dinosaur or you're dead.
Or you're yes, dinosaur dead, I think is actually fairly reasonable, and there are any number of people who are really good at systematic value strategies. For example, Cliff Asness, like on Twitter, hates me, right? Has blocked me, refers to me in various profane ways in his Twitter. I'm like, dude, you're a billionaire and I'm nothing. So like the fact that you're even paying attention is hysterical. But the reality is that all those strategies are actually predicated on some idea that like all this information is flowing into the market and all these furious little monkeys are typing on their spreadsheets and like changing their positions based on the information flow of the day. And there's just no evidence for that anymore. Mm-hmm. Right? It just doesn't exist that way.
I mean, I can and have gotten into like how my process is constantly evolving.
Yep.
But how I try to deal with this, and let's get into these ODTs, is I take systematic snapshots because I can't change how I am. I've spent 24 years to basically fade myself. Okay? So I don't want to be the emotional hockey player I was. I don't want to be like what I see in the market today, which is just a bunch of emotion, wrapped up in more emotion. I mean, I want to fade both myself and the market, so I've systematically created rules that I cannot go with what I think. I have to go with what my process tells me to do. So, so I take 6 different snapshots, for example, of ODT, most active options board. I only look at it 6 times. Because if I look at it all day long, I will go from white hair to no hair to gaining 75 pounds.
Yeah.
It would freak you right out. And I can't imagine somebody who's on the switch at a major hedge fund trying to trade that and look at that all day long. That's got to be unbelievable. That is like playing, literally sitting at the roulette table all day long.
Trying to divine patterns, No,
yes.
It's just, it was black last time, this seems to be red, right?
But I'd say that my accuracy's gone up in short-term signals because I've incorporated that flow. So everything from at lunchtime there's a lull.
Yep.
I call it the lunchtime lull. Volume's dry, like right now. Market can be taken higher if there's a center book that wants to keep grabbing higher strikes. And it's like, just let it happen. But by 2:30, those ODTs are running out of time.
Yep.
And then there's a different setup into the close. So this has changed quite dramatically for me, and I trade actively.
Well, it's changed quite dramatically, and really just in the last year and a half, right? I mean, zero DTEs used to exist as we came into option expiry on the monthly or quarterly, and then they moved to weekly, right?
Yes.
And then suddenly they discovered, wait a second, there's a ton of demand for these, so now let's move to daily on many of the indices. We're actually now talking about doing it on single stocks, et cetera. The problem is, in some ways, and I've had to devote significant resources to it. It's funny that we're sitting here, not so funny actually, but being in the ETF space, you have to kind of decide what are you going to focus on, right? And so Simplify, very focused on developing products that can be used by registered investment advisors and individual retail investors. In some institutions, we have a growing institutional business that's built around building portfolios that allow people to do stuff. But on the research front, right, you're limited in terms of how much you can ultimately do. And so one of the projects that I've become involved with is Tier 1 Alpha, which puts out a morning note tied to options-based theories of markets. And as markets have become more structured, more disciplined, as you were describing, the options are actually becoming a tail that wags the dog, right? And so we see this explicitly in zero DTE. Now, the exciting thing for you and I is that we're actually going to partner on Tier 1. So we're in the process of signing that agreement. We're on a done deal, and we're actually going to start distributing Tier 1 through Hedgeye. And so I'm really excited about that. This will be a lot of fun.
It's awesome. I didn't know how we were going to announce it, but it just came up.
Yeah, right? There it goes. Yeah.
So we're officially, we own part of Tier 1 as well.
Yes.
So we're going to be an owner in Tier 1, which is a fantastic product that helps augment my process. And we're going to be partners. And I think, you talk about troglodyte. Mike Taylor and I, when he first met me, and he's like, "You're like the troglodyte of Wall Street." I'm like, I look it up. There was no ChatGPT, but I'm like, that's not a compliment. But now, like, we kind of have a tripod.
Yeah.
Because you have Mike, who's only one and only Mike, and Mike Taylor. Then we have your Tier 1 Alpha lens, the Hedgeye lens. This is really starting to get like where we wouldn't have done this unless I will not promote or talk about, certainly invest in any tool that can't help make me money or save me money first, which is actually, in the case of June 15th, was a really important exercise because you could have lost a lot of money chasing that day.
Absolutely, I totally agree. And that for me has really been part of it as well. It's just making sure that I've got that map at every stage in the process to say, this is what the actual landscape of the market looks like going into the day. I actually write a portion of the Tier 1 note every morning, which is just literally part of my process. I'm reviewing the charts that have been put together by the rest of the team and reviewing the information, and then I'm writing out my thoughts as attached to it, right?
Well, that literally mirrors my process. The Rooster, I was talking about Tex and Rooster. We're going to have a show, Tex and Rooster, Ryan Ritchie and Taylor, two analysts that work with me. They feed me. They feed me all my implied vol data once Bloomberg resets at night. They give me everything I need to look at. Then my early look note is just summarizing what I just looked at. So what's critical is what you look at.
Absolutely, absolutely correct. And by the way, you mentioned things like implied volatility, right? So I mean, everybody immediately gravitates to things like the VIX, right? And we use these as metrics for the fear index, right? But remember what is actually happening there, right? So what you're being told is this is the price of options on the S&P 500 across the strip, right? And so when those options are being sold to you, the dealers are pricing them at a level that basically is guaranteeing that they make money, right? This is a casino. At the end of the day, they're going to make money on those options. And as it's become much more transaction-oriented, much less about prop desk trading, directional trading, they're taking fewer and fewer risks. And so they're always going to price that stuff, and they're always going to try to hedge their book in ways that are truly mechanical in their construction. And this is driving so much of what we see in the day. It just becomes really hard. And we could pull up a couple of charts to show some of these things. If we pull up the first chart in the options gone wild pack, this is actually looking at what's called the gamma of the distribution of all the call options and strikes that are sitting out there in the market right now. And you can actually see this kind of centering around the middle. If you think about what gamma is the change in delta, that hedge ratio we were talking about, for a change in the price of the underlying. And so a map like this actually starts to tell you how option dealers are going to behave, where they're going to be forced to actually start buying more futures, where they're going to be forced to start selling futures in the case of if they've actually received call options. And in general, what you see here is on the top side, this is stuff that has been sold to dealers, and on the downside, it's stuff that's been purchased by the street, right?
It's so tight. Like at the bottom there, you can say where all the pin action, it's between, basically 42.50 and 44.25, which is where you stop going up on June 15th.
Exactly. So flip to the next chart, because I want to show exactly that point. So this is actually one of the key things to remember with options. This is when I'm talking about all expiries, that includes stuff that's like, if you think about your inbox on priority, right? It's like, well, some of that has next week's work in it, right? You're going to have to manage against that. But this 0 to 2 day option stuff, these very short expiries, that's where that tightness is occurring. Right? And the P&L of an option dealer is going to live or die by their ability to basically hedge out their exposure in this range. And so this very narrow range is what we're experiencing. And it's why you're seeing all sorts of weird things. Like, today the Russell 2000 is down, the S&P is up, right? Well, part of the reason why that's happening is because if the mega caps are getting pulled in one direction and you're an option dealer dealing in index options, you got to chase those, right? Because any replication is going to include those. But what are you going to do in terms of replicating that exposure across the S&P and making sure that you're actually managing it? Well, you're just going to fade the rest of it, right? You're not going to buy the really small stocks. And so that contributes to this neglect that's then happening on the other side of the extreme. And you get these really weird patterns.
And yesterday was the opposite.
Yesterday was the opposite. Exact opposite.
This is primarily why I take those 6 snapshots. And they do change, obviously. You can see who the lead horses are. Right? And Tesla weeklies are usually in there too. Right next to SPYs, but you can see where there's a motivated. This isn't just, and let's actually go through a couple more slides, but then I want to get into this isn't just a bunch of retail monkeys. Quite the contrary.
Oh, it's the exact opposite. Right. On our estimates, about 85 to 90% of the volume is actually coming from the institutional space.
But putting this in context of institutions, this next slide, this is really good because, for my whole career and yours, by the way, you had to actually, like we would call it, buying bombed out puts or just having protection on the portfolio. I mean, it's like evidently you don't need that anymore.
No, so that's actually, this chart, and just to give people this map, so this is effectively the cumulative distribution function tied to all those. So it's just smoothed across those various those components. And one of the things that's really interesting that's happening in this market is people are so tired of bleeding on protection that they're just buying put spreads as compared to buying puts.
Yes.
Right now, if you think about the construction of the VIX, and again, most of this is happening inside the VIX. There's another chart we'll show that shows the declining volumes of the VIX. So it's actually becoming less important or less indicative of real stress in markets. The VIX itself has some interesting characteristics on that. But what you're actually seeing here is you're seeing people buy some downside protection and then selling the extreme downside protection. This is putting pressure on what's called skew in the market, right? So those tails themselves are actually relatively cheap. And if I go back to that realized volatility that's tied to those 0 to 2 day expiry options, you got this really, really tight behavior. The market feels comfortable that it can hedge within a range. The problem is what happens if that range shifts in any meaningful way? And we saw that to the top side over the last couple of months, right? Once markets started to push higher, people are like, oh my gosh, I'm underexposed, we got to chase. That's June 15th was kind of the peak of that. And on the flip side of that, you saw in October of last year, you saw in June of last year, around similar option expiries where people are like, oh my gosh, I don't have enough protection to the downside. And they chase the vol spikes into those events.
March of this year, I mean, it's. I always say, risk happens slowly, then all at once. I mean, within a regime, this is essentially, I think, one of the most important questions for me, because it's one thing to have a bullying of the option space, and let's talk about that. If you want something to print, you can get it to print if you're playing with the biggest hand. But that doesn't mean you can change the economic cycle. That doesn't mean that you can change God, I pray that NVIDIA has the best quarter you've ever seen since reporting quarters. You can't change what companies report. You can't change, and a lot of that, if you go back to it and you just look at it, it's the first time these mega caps actually missed and guided down that we had that phase one of the bear market.
Absolutely.
But you had everything in between still happening.
And people forget. I mean, exactly like we saw in '99, 2000. By the way, like you saw. The generals were the last to fall. Right? So they were pushing up into the highs in late 2021. The Cathie Wood type unprofitable tech stuff started falling in February of 2021. Right? It was in a full bear market by the time we got to anything resembling a bear market. Now the irony is I would say we're seeing something really similar right now. Whereas if I look at something as extreme as like an equal weighted Russell 2000, right, which dispenses with all the size components and basically says let's look at the majority of individual stocks. That's down for the year.
Guys, show the NASDAQ equal weight that I was showing on the macro show this morning. I mean, look at this chart. I mean, I think you can see it on the look at that. That's NASDAQ heavyweight versus equal weight. I mean, it had an up day yesterday. To your point, that yesterday was an anomaly. Equal weight outperformed Qs by like over 160 basis points. That's like a little blip on the chart.
Absolutely.
So it's like, hello, and then you get every signed, sealed, and delivered, like kind of old wall media person looks at the headline of the tape and thinks that's the economic cycle. So you're starting to see that commensurate narrative of, oh, you idiots thought there was going to be a recession as we're entering an industrial recession. You see this whole thing where people that have absolutely no process whatsoever are coming with these natural, what you should expect to be summary conclusions about the economy.
Well, it's also the flip side of it, though. So, I mean, it's not just media that's doing this. Remember that our elected officials and appointed bureaucrats are doing this as well, right? Where a direct lead-in to many of the models is, how's the S&P? Right? What are credit spreads look like, right? And so we see this across fixed income markets, equity markets, et cetera, where the fundamentals are increasingly disassociated. And I would just highlight, like when you start thinking about quant strategies, right? With a quant strategy, you want to use data that's available to you very frequently. Because like if you update it every quarter, right? Well, one, people aren't going to pay, which is basically kind of what value investing is supposed to be. Like, let's look at the financials when they get published and let's obtain the scuttlebutt. You don't get that much frequent information in that form, and you're supposed to ignore price, which is 99% of the data that we end up receiving on a daily basis. To your point, if you're like stuck there watching the market, like all you're doing is watching price tick. Right? You're not actually watching the fundamentals change in real time as that's occurring. So when you think about most of the quant strategies, they're all predicated on something tied to price, right? Like how volatile is the stock, right? Is it a high beta stock? Is it a low beta stock? Is it a high dividend yield stock? Well, dividend yield is a combination of price and the dividend that's being paid. The dividend doesn't change all that often. The price is what changes, right? And so everything in the markets now is increasingly tied to the price component. And ironically, like the only thing that actually derives value from the underlying price are options. right? So naturally, we're gravitating to stuff that is a direct expression of the thing that we're all watching all the time.
Well, it's the only, I mean, it's like, just to call it out plainly, you said the dealers are ripping people off all day long. That's a fact. I mean, you can ask anybody who institutionally runs an options book at scale. That's like, no shit, Sherlock. I mean, but Goldman makes a lot more money. Goldman, Susquehanna, just think Citadel, the three big ones. They make piles of money here without paying attention at all to economic cycle.
They literally do not care.
It doesn't matter.
Because they're delta hedging everything out.
Yeah.
The only reason they ever care is if you actually see discontinuous price action, which means hedging is really hard, right? So if you're continuously hedging, if you have high frequency trading capability, you're continuously hedging those exposures, managing yourself within a reasonable range, it's when markets gap that things can change. And so, if you go back and you look at markets where we've previously seen this type of dynamic where a derivative has become the dominant strategy, it's hard to avoid comparisons to like February of 2018 with the Volmageddon type dynamic, where people became super comfortable with their hedging exposure and the characteristics of the market that was in place tied to the VIX, and then an unexpected event occurs.
Well, I mean, it's. I mean, you don't have to be even remotely close to going from where Mike Taylor went to world class.
Right.
I mean, it's like Russell volatility is trading at front months trading at 21, not at 13. NASVOL or Nasdaq volatility is trading low 20s. And it's not like you don't have even dispersion, just like you have in credit. I mean, that's another topic I know you want to get into.
Yeah.
I mean, the dispersion is epic.
Yeah.
So we have, anytime I see dispersion, but I see ongoing economic deterioration, I'm like, this thing is going to have, like I call it, like, we've seen phase one of the credit event, we've seen phase 1 and 2 of the bear market, but we've not seen phase 3, the finishing move. And I wonder, what are your thoughts on the current structure? If you only looked at the mechanics on how one day you could have a 1987, or you could have just one day where it's like, shit. What?
So 1987 is an interesting one, right? Because there are actually limitations in terms of circuit breakers that didn't exist at that point.
Yep.
So a 1987 event type headline, which is what happened in Volmageddon, right? So the XIV went to 0 basically overnight, right? A more extreme version of that. It is hard to achieve. But what becomes really interesting is, could you get 10% down days in a row? Right, that's where it starts to get, where it effectively goes limit, right?
Like we just had 550 basis point down days in a row.
Right.
And it was like,
multiply that by 20.
Shaggy, it doesn't work anymore? It's like, the guys buying that, like literally the Tesla weeklies last week traded at, they're chasing 275s, 280s. Yesterday, closed at 241.
Yeah.
It's like, Shaggy, it's changing.
There's just something, we know this, and everybody feels it, and everybody tries to create various stories to make them feel comfortable with going to work every day. But
it's crazy.
We know that there's nothing economically that makes sense when you see a company like NVIDIA gap in the way that it did, right? Where it's a 30+% move in a $500 billion market cap company, right? I mean, that sort of move is just not supposed to happen in a market that potentially, at least theoretically, is supposed to be capable of absorbing information in any way, shape, or form. It's not like their earnings were that much of a surprise, right? What was a surprise was how inelastic, right, to use the economic term, the supply of shares were.
Yes.
Right? So people were forced, people had highlighted that with, like, it's a short squeeze. That just wasn't true. There was like $8 billion worth of stock short on a $500 billion market cap company. There's nothing extreme in that framework until you actually realize that not that many shares have to trade, particularly if it's going into these types of vehicles like an XLK, for example, that has to buy crazy amounts of NVIDIA when you put money into it. Right? I did this, I also write on a Substack, and again, that's just part of my process, trying to think through the dynamics of a market. If you actually look at how much NVIDIA moves for an order, right? So $1 trillion market cap company, if you were to put in a $10 million order, would it surprise you if it moved 0.08%? That seems totally reasonable, right? Okay, that's $1 billion in market cap. So for a $10 million order, you're creating a $1 billion increase in market cap for NVIDIA.
Yeah, a 1% move in NVIDIA, I think, is around 10 billion.
Right. Well, by definition, it's $1 trillion, right? So there'd be no math in these things. but you're literally looking at this sort of stuff, and that's just not supposed to happen, right? So I mean, we're back to what we saw with Bitcoin, for example, where there's this inelasticity. If you've trained people, you've given them a religious devotion to not sell as price goes higher, well then guess what happens? As the price goes higher, they become less willing to sell, the price starts to move exponentially. That's what we're seeing across these instruments. I put a lot of it at the foot of option-based strategies.
Yep.
Strategies like I highlighted again, quality, right? So quality is a really interesting quantitative strategy in that the rationale for why you should buy quality stocks is because historically they have been underpriced, right? Well, what's the right price for them? If you actually look at the algorithm, there is no right price. The evidence for quality is quality has historically outperformed, and the rationale for that is because it must have been underpriced by market participants, therefore it outperforms. Therefore you should buy it. Therefore you should drive the price up. Therefore, as the price goes higher, it's evidence that it was underpriced, right?
Yeah.
Like these circular logic things are just permeating the market instead of people actually sitting down and saying, hey, wait a second, there's a really good article about the potential impact in AI for Microsoft, right? And it's like, Microsoft could gain up to another $100 billion in revenue by 2030 on the basis of AI. And you're like, it's a $2.5 trillion market cap company. God, I hope it can get $100 billion worth of revenue out of AI over the next 7 years, right? Like that's, you see these sorts of things and you're like, so I'm going to pay 25 times forward revenue in 2030 on this?
I mean, once you've rationalized that it's not rational on that basis, that's why Tesla's number one on the board on single stocks. I mean, that's the most egregiously overvalued company in the history of companies. And according to us,
Yep.
Jay Van Sciver, I'll blame him for saying that. But he like he always says, this company, Elon's in the business of selling stock and stories, and he's become unbelievably wealthy, getting people to believe him. But of the things that he's said over time, you get a significant percentage of what he said is complete and utter bullshit.
Yep.
Right? Burrowing company. I don't know. I mean, what's the latest? But the fact of the matter is that there are enough people that believe to have center books and big institutions, capture their belief systems. And is it the same ratio on something like that daily? You said about 85% is institutions. On something like Tesla, have you looked at that? Because to me, it's absolutely fascinating to see. I mean, it's a notionally high price stock, so the options are. It's an unbelievable amount of participation in these weekly options.
I wish I had the chart to show this, but another area of work that I've been doing are things like corporate share buybacks, right? And so those are meaningfully impacting the market on my analysis. The interesting thing about Tesla is that it doesn't have its own corporate share buybacks, and he basically has used the ability of having a high price stock to allow him to fund himself at various points in time across all these various shenanigans. And I broadly agree with you. I think there's some really interesting truth that sits at the center of anything like electric vehicles. But at the end of the day, Tesla's selling like a performance vehicle as an environmental type solution.
It's great.
It's they've managed to tap into an amazing market where people are like, this is the most incredible vehicle I've ever experienced, except for the quality issues and the service issues, et cetera.
And in other news, Lordstown went bankrupt.
Lordstown went bankrupt, right? But that's actually a perfect illustration. I mean, the market cap on Lordstown went to billions of dollars on total vaporware, right? I mean, they were...
Stock was at 400 at one point.
Completely
it's a zero.
Insane. So the reason that I would actually highlight that is when you talk about exactly that type of dynamic, like what was the event that actually created the must-buy for Tesla? It was the S&P index inclusion, right? And so if you actually look at what happened to the S&P index inclusion when the index ARBs knew that he was going to print that fifth quarter of profitability, when they knew it had to be included because of the size, that turned into just an absolute free-for-all.
Yep.
My understanding is Millennium, the asset manager, the hedge fund, made north of $3 billion on that inclusion event because they realized that they could buy in and simply not sell to S&P. And the Vanguards, et cetera, of the world weren't going to sell either, right? And Elon was not going to sell because of the risk of getting caught in that sort of event on the SEC, right, on an inclusion type dynamic. So every single part of that was just wired to cause that stock to go ballistic. And what did it do? It went up like 500% over the course of basically no time whatsoever, right? So that type of dynamic we're seeing just over and over and over again. Same thing, like you talk about the craziness of GameStop or of AMC.
Yeah.
who was the biggest buyer of GameStop? The index funds,
Yeah,
right? At one point, it got to be the largest component of the Russell 2000 value.
Yeah, it's like and I think it's okay as long as you watch it. Like, you're going to see, like, this is the whole point. Like, as soon as Tesla failed, as soon as those weeklies failed last week, that was indicative of a broader state. You know, to get it to stop, you need people to lose money, right? I mean, you get, if it's only 10 to 15%, I think in Tesla it's got to be more, because it's just the endemic nature of that name. Within Moab, or the mother of all bubbles, I think that he and that stock is right at the middle of all the concentric circles. Yep. And they include everything from the farmland bubble to the credit bubble. There's a lot of different bubbles out there, right? But I mean, that is really the fulcrum point. And to get people to lose money, to me that's one catalyst, or to get those institutionally playing the game to stop making money. What do you think about that?
Well, I definitely think there's some truth to that, but I think that also, and we could actually, why don't we flip to the very last slide, because this is some of the new stuff that I've worked on for a long time that we're actually beginning to incorporate the capability for Tier 1. So this is kind of the next step, the next process that we're going through, where we're starting to actually model out the flows that are coming from systematic strategies, right?
This is the 401k flows?
Yeah, this is the 401k flows, right? So this is actually looking at money that is flowing into 401ks using effectively target date funds across different age spectrums, and the participation rates, the employment rates, et cetera, for each of those, to kind of model the cash that is flowing into the market, into these index funds, with no thought process behind it. They don't care whether they're making money, whether they're losing money, et cetera. They're defaulting into these allocations, right? And so as long as they have a job, this money is coming in.
Yep. Right?
Now, when Tesla becomes the 7th largest stock in the index, guess what they're buying without intending to, right?
Yep.
Nobody's sitting there saying, that's not true. Some fraction of the population has constructed a narrative for themselves of, Tesla stands for just don't sell us, right? To use the 2000 analogy on JDS Uniphase, right? But the vast majority of it is legitimately just people who are like, you know what? I just put my money with Vanguard or BlackRock or Fidelity's target date funds, et cetera. And I don't want to draw the direct analogy, but what would you guess actual stock ownership rates were, the participation rates in the stock market in the crash in 1929, going into that event? Because it was Wall Street fever, right?
The percentage owned by individuals?
The percentage of households that owned stocks going into the 1929 event.
15%?
That's not far off. It's about 10, right? Today it's 54. So when we talk about the stock market, right, we're literally, this is the asset. This is the retirement asset, right? Yep. And it's just funny to me that, like, cavalierly in the last 2 years, we've basically gone out and slaughtered all the sacred cows, right? We have to drive home prices down. Well, that's a retirement vehicle for the vast majority of Americans, right? For a significant fraction of Americans, that might be their single largest asset. Then we got 401ks, right? 401ks, people are supposed to rotate into bonds. Well, what does the Fed come in and do? Raise interest rates 500 basis points and just destroy the bond market, right? Take it for losses we've never seen before. Now we're actually sitting here looking at, the mother of all bubbles across equities or various other asset classes, and systematically it feels like we're just hunting these sacred cows, right? We're just, we're going to take bullet after bullet after bullet, as we basically acknowledge that a lot of the stuff that we're facing is, to use a phrase, unsustainable.
Well, in the end, like I've always thought, this is exactly how it ended in 01, 02. You lost a whole generation of investors. It's by losing money. Yep. When everyone needs one thing to work, this is why I always say my job is to make money when everybody's losing theirs. I mean, that's the last 5 of the last 6 days, or flipping long now. It's like I care. Right. What you should really care about is the rules and regulations around this. And I get that question a lot. Like, is this legal? Like, is it legal?
Is it legal? Is what legal?
To institutionally bully a Tesla call option to 280 and punt?
Theoretically, no, it shouldn't be, but under the letter of the law, in most situations, it is, right? And so
theoretically, you're not allowed to mark up portfolios into month end or quarter end.
Right. Well, I mean, correct, and we know everybody who does window dressing, et cetera. But I mean, if I'm going to start picking on things, right? So most people will turn around and say, they'll get upset about stock buybacks, and then you'll have the whole crowd, chime in with like, oh, stock buybacks are, perfectly legitimate form of return of capital, it's just more tax efficient than dividends. Well, that's not true, if markets actually have frictional characteristics to them, right? And so this is, again, like the really big change. You and I are of similar vintages, and we grew up in a world that was largely dominated by the information flow theory, right? You and I were, you as a consumer analyst, me as a small cap guy, would sit there and we'd be like, okay, I'm going to sit on the earnings call and I'm going to model the changes through, and now I've done a DCF and the company is marginally more attractive or marginally less attractive, and therefore I'm going to make choices within my portfolio based around that. That just doesn't happen anymore. It doesn't happen when 94% of those under the age of 45 are just flowing their money into a total market fund or a S&P index fund, right? That's not how decisions are getting made. They're being made effectively by a flow of capital that is coming in through retirement funds or through various other components, piling into funds that are automatically putting this money to work, right? That changes the characteristic of the market from a prediction mechanism to almost perversely being tied to the most lagging of indicators, which is the employment market. As long as you got a job, as long as you're contributing to that 401k, even if you've been laid off from Google and you're receiving severance that continues to contribute to your 401k, right? You're buying that stock market and you're contributing to these frictional flows that are contributing. Add on something like a corporate share buyback where they're in there competing with you for those same shares. And doing so on a systematic basis through what's called an accelerated share repurchase program. And all of a sudden you start to realize why we're seeing so much of the behavior that we're seeing. It's just, it's not a thought-based component. It's just we as humans then have to turn around and apply thought to explain it to ourselves, right?
And then humans will always come back because they're always, they're always revisionist historians, right?
Yep.
I mean, our subscribers are as guilty as anybody. I mean, they'll be like, how could you know all that and not just be long? And then all of a sudden, forget every single drawdown we've had since this started 19 months ago. I mean, it's like, you can do whatever you want in hindsight. But in the particular moments of this clock or cycle time, as Gatherall would say, like inside of these places, there are particular times where you can get killed, chasing. And that's the main thing that I keep coming back to with people is that, and again, highlighting those dates, June 15th, February 2nd, November 5th. There's only been 3. Where you got to that kind of crescendo.
Extreme,
So.
Yeah, I mean, I would actually argue that we've seen a lot of smaller versions of that.
Little ones.
The most interesting ones are where the market is effectively shocked out of that range, right? That narrow range that I showed for the zero data expiry options. Why don't we pull up the chart? I think it's slide 24 that looks at the declining volume in the VIX options relative to the increasing volume in the Gendron. If we could pull up slide 24, it should show the declining volume in the VIX tenors. Let's see. Oh, that's actually a useful one to highlight as well. But so this is the percent of stocks outperforming the S&P over the trailing 12-month period. One of the things that becomes very, very clear is just they're not working, right? So if you're a stock picker, dude, this is a bad environment for you, right?
Or if you're me, people again, they don't get it because they don't play the game this way. But I mean, I don't have a position in SPY basically ever.
Right.
My only index position is IWM. And it's an entirely different thing going on.
Yeah, it's a totally different thing. I actually would encourage you to reevaluate that, just given the underlying nature of the way these things play out. But if you pull, I think it's the slide after that. I apologize. So after or before? Nope, this could be before. A couple back. And one more. One more. Keep going. Couple more. Keep going. I'll shout. I thought it was slide 24, but let's see here. Keep going. All these slides, by the way, are going to be available on your website.
Okay, cool.
Just to walk people through some of this stuff. I really want to show. That's it. This is the slide I want to show. So this is actually looking at the change in volume that's coming in this 0 to 1 day expiry options. And you see this upward red trend, this line that's showing this explosion of volume. The chart that's actually more interesting to me is the blue line, which is showing that we're not transacting at the 30-day point anymore, where the VIX is actually being done.
Right.
So in other words, the VIX is increasingly less and less representative of what's actually being priced. People are just not using it. Right?
This is great. I mean, it's for those of you that don't know, like front month VIX, when you look at it, that's a 30-day realized price. Wow.
So there's just been this absolute collapse in that reference point, what we call the fear, the fear index. Nobody's really using it anymore. Nobody's using those options because they're just too expensive even with the VIX is down as low as it is, they're just too expensive versus what people have been experiencing.
Is there I mean, first of all, the answer is going to be yes if you go back far enough in time. The number one thing that I learned in college, away from the 99% of what I learned what not to do in the economics department, was Bob Shiller's long-term mean reversion charts.
Yeah.
Is there a mean reverting nature to that one, or because the time series is so short that we don't know?
So we don't know about the volume component of it. That's one of the interesting things about volatility, is the volatility is one of the most mean reverting. It's not a normal distribution. It's distinctly right tail skewed. Yep. And it's actually getting more and more right tail skewed. Unfortunately, I don't have that slide in there, but I'll include it in some of the tier 1 stuff just to remind people of this. And it's a great exercise, actually, that your listeners can do at home, right? Just to download prices in the S&P 500, the Russell, the NASDAQ, or the VIX, right? You can pull all this off of Yahoo Finance or Google Finance, et cetera, and actually run the analysis on the changing distributions that you're seeing, right? You can just do something as simple as skew, right, as an Excel function. It's also, I believe, available within Google Sheets. But you can actually see these numbers changing over time and the market is becoming more and more non-normal, right, in its distribution. It's becoming more right-tail skewed in VIX. It's becoming more left-tailed skewed in terms of the underlying indices themselves.
This is going to be critical for me, for my process, because again, my signal, I don't want to go into the details, but again, price, volume, volatility, and the relationships embedded therein. So what really needs to change is the lens on those shorter dated options as opposed to just that 30-day.
It is a really big deal, and I would just encourage people to keep paying attention to that, because when we talk about things like the fear indices, et cetera, and one of the very first charts that we show in every tier 1 is the very short dated VIX surface. Like if we go back to last year, just to highlight that sort of chart, if we go back to last year, you would see Fed events and you'd have single day vol around Jay Powell speaking of 50, right? And it was basically like people like, oh my gosh, Jay Powell could say something and like it's going to move the market in some insane way. This last Fed meeting, we had the implied vol, I believe, was 14, right? It's just like nobody cares anymore. This is, we occasionally jokingly put up the Tommy Lee Jones from the movie The Fugitive, right? I don't care, right? It's like nobody cares anymore. Candidly, because they haven't been rewarded by buying volatility for a very long period of time.
Yeah, I mean, once you and this is what creates risk, and when everybody thinks that it's payday all day, eventually too many people are at the same trough, feeding on the same trough. You don't really know when that's going to happen, but I'd submit that history. Actually, if you look at the history of the VIX relative to when you are entering a recession as opposed to actually in one, there is a phase transition in volatility 100%. To the upside where it's like, oh shit. And you could really actually, if you really think about that intuitively, it makes sense. You get everyone on the old wall saying it's not a recession 100% of the time. Oh, now the new thing to say is that, well, it's going to be a soft one. A recession's a recession. In 2001, you could barely see it. And people, a whole generation of investors went away. But when you make that switch, and I think that time's a lot closer to T minus 3 months because of our Q2 GDP number being negative, and our number, the street's at a positive number. I think that you're going to come to a realization where you just, and throughout earnings season too, where you just can't believe how fucking bad the numbers are.
Yeah. Well, you see this if you look at, I mean, again, like not to get overly detailed, but the numbers that you see in terms of S&P earnings estimates are always the operating earnings, right? Which is basically, the earnings, when we ignore all the bad stuff, it's never going to happen again, right? If you use GAAP earnings, we're already in an earnings recession. It's significantly lower. Look, I think a lot of what's going on right now is basically people rationalizing the rally and telling, explaining why the rally has occurred in hindsight as compared to predicting it in advance. And now the question is, do we actually enter into that recession? I would actually highlight the reason why I gravitate to things like options or even credit is because they tend to have their own catalysts. We call them maturities, or we call them coupon payments, or et cetera, right? In the credit markets, this to me is the most interesting one, where we're seeing this incredible divergence that is developing. And I would describe, I put a chart in, I don't think I have it in this pack, but we put it fairly regularly, and looking at the difference between what companies are currently paying, the equivalent of like the cheap mortgage that everybody locked into in their homes in 2020 and 2021, corporations are currently paying between 4 and 5.5% coupon on the debt that they have outstanding. If I look at what's priced into the high yield market right now, they would be paying somewhere in the neighborhood of 8 to 8.5%. If I look at where new paper is actually coming out, right? It's like 12.5 to 13.
Yes.
And most of these companies, now most households can do that calculation. If my mortgage payment were to triple, what would be the implications? With 30% of household income going to service mortgages even today for most new homes, like tripling that is a very bad thing, right? So you're seeing similar dynamics within the credit universe, where on my calculations currently about 85% of the credit universe is operating profitable at current levels of coupons. If I look at the new issue paper and that maturity wall that's coming in 24, it's like 7% is profitable on an operating basis, right?
7% of the publicly traded debt, or
of the high yield universe. So not all of them are publicly traded, but this is the universe of companies that are actually represented within, say, high yield.
Well, I mean, it's like tangentially to that. You could triple C's trade at 13.
Yep.
You know, the real shit. Like, this is my point. Like, once you know it's shit, it's shit. Yep. Like, you can't, like, this is the whole point about entering a recession. It's only the third one in really a quarter century.
Yep.
And I don't want to go off on like how this one I think could be the one that drips and stays longer for too long at this cost of capital. But you could also look at private markets. The hottest markets right now are guys that are extending private, bridge, mezz, construction loans to get projects terminated, all 12, 13, 14%.
Yes, correct.
So that's like, to me, those things happen when the cycle happens. That's why credit trades in sync with the rate of change of cash flows.
100%. And again, like if you move beyond kind of the headline public stuff, one of the charts we highlighted, and occasionally we take these detours within tier one, where we'll talk about things like the credit markets, right?
Yeah.
And so, SAP is an enterprise software company. Veritas is a privately held software company whose debt is actually available, publicly traded. More accurately, their loans. You have to have the pricing series to run this sort of stuff. SAP is trading at 100 times earnings. Right?
People ask why the DAX doesn't go down.
Exactly.
It's the number one weight.
Right, exactly, right? So you look at SAP at 100 times earnings, and then you look at a nearly direct peer in the form of Veritas. Their debt, their loan, their first lien loan, right? So the top of the capital structure is 17.5% yield.
Really?
Yes.
Oh.
Right, and you just sit there, you look at it like these two things actually can't be true at the same time.
No.
Right?
By the way, just because I want to ask a couple of the questions that are rated. No, you can't make this stuff up at this point. I mean, that's why I think, by the time, wherever the end is of phase 3, there's no actual person on Wall Street that has any credibility risk managing cycles. And a lot of people don't have any credibility at all. Don't tell me about some person who only makes money in bull markets. Tell me one person that can't see the 100 basis points of inversion on the yield curve, what you just said in credit, or industrial production growth going to zero. This has already all happened.
They can see all that, but what they actually can't do is then reconcile that with the market, and so they immediately move to, well, the market predicts.
Yeah,
right? The market's telling you what's going to happen.
Which is perfect if you're the person puppeteering it.
Right.
Now, I don't want to get into what I would do if I had that center book, but what would I do? I just look at every single long-short hedge fund manager that's on my platform. Every time they lean one way after a fundamental event, let's say when Lowe's blew up, or Home Depot for that matter, it's like, oh, now they're all shorted. I'm just going to start buying it, for the center book. You can see what every human who thinks this is all fundamental does.
Yeah.
Until it actually, the whole thing becomes quite fundamental.
Well, and remember, at every step in that process, the next person who's buying almost has to be a fundamental buyer by definition, right? So if a mutual fund that is buying high yield paper but has limitations in terms of what credit quality it can buy is forced to sell. This is part of what's happening in the triple Cs, for example, right? So the triple Cs can't be owned by many of the mutual funds that own high yield paper. They're below the credit cutoffs that they have for BB minus, right? And so when it moves to triple C, it becomes a piece of paper they have to sell out. That then prices exactly where the private markets, where actual transactions are occurring, happens, right? So that's the true price. We've been emphasizing this within Tier 1 again, like you talk about the Russell 2000, that to me is truth. What's happening in the S&P or NASDAQ, that's index arbitrage sort of fiction, right? Every time you show up to buy the total market index or buy the XLK because you buy into this idea that maybe, AI is the solution to every problem we've ever had as human beings, right? Some skepticism there, although I'm actually quite bullish on the space. But when you think about what's happening there, you buy the XLK, 70 cents of your dollar just went to Apple, Microsoft, and NVIDIA, right? It's just crazy.
It is nuts. All right, this question from a Canadian gets the top voted question. Not surprised. With AI, Canadians are going to rise, I heard.
Yeah. Hey.
The intellects of Canadians, eh, bud? All right, Sam from Canada, thank you. Are there markers of instability in the options market that you're watching every day as leading indicators of a breakdown of Moab? Thanks.
Well, I wouldn't watch the equity markets for the breakdown of Moab because it tends to be one of at the top of the capital structure. It's basically the residual on a lot of this stuff. But things I am watching very closely, and these are all publicly available, you can pull them off of like the CBOE website, are what are called the correlation indices. So as distinct from the VIX, what you're actually measuring is the difference between the pricing of index volatility and single stock volatility, right? So the index vol is actually just a combination of the expected or implied correlation against those two metrics, right? What we're seeing is a complete collapse in correlation, right? That's telling you that the index vol is being underpriced or is being very cheaply priced. People are assuming that despite the S&P becoming more and more concentrated in a few names, that the index is becoming more and more diversified, right? Now that's just a ridiculous statement, right? We actually know, just imagine that, the entire index becomes Apple or Microsoft, right? Well, we know it can't have correlation. Therefore, just mathematically, as they get larger and larger in the index, the correlation should be rising. We're seeing the opposite, right? And so I'm very closely watching, in particular, what's called the 90% delta correlation, which is effectively that deep in the money put. That is the lowest it's ever been in history. In other words, the market is basically saying, well, yeah, things could crash, but it would happen in a totally series of idiosyncratic fashion. There is no such thing as a crash for the S&P.
It's a really good answer. I mean, we call it the sinkhole, right? Like the S&P 500 is the surface is the final thing to cave in.
Well, I wish I'd taken it more seriously, but back in 2016, Scott Besson, who runs Key Square up here in Connecticut, used to run Soros. He made the observation that, well, maybe the S&P really is just like the thing nobody can beat. And what he didn't articulate is kind of what I say or point out to people, which is the S&P 500 is a little bit like, the admonition of don't stick your arms and legs outside the moving vehicle, right? That's where all the money is coming, right? Yeah. So like you try to deviate from that, you're going to get your arm ripped off, you're going to get your leg ripped off, right?
That doesn't mean you can't. I almost died in Ireland that way a couple weeks ago because I was getting off the team bus that we had and I forgot about this, after a couple Guinness. It was just very close.
Well, you could have been that character from The Simpsons who didn't have an arm, remember?
So just when you think it, when you stop thinking, actually, that's when the problems occur. A quick last question here. And a lot of people have this kind of same question, so take your shots at it. But I mean, a lot of people are bearish. Like this Dan from New York is like, look, I'm guilty. I'm positioned for a big crash. I have short-term FOMO at the same time. I agree that markets, a lot of things that I say. He says, I think the Titanic will go under. Again, everybody wants to know when, which by definition means that nobody knows when, which means that the most amount of people are going to get hurt, at that when.
Yeah, no, it's one of the reasons why I highlighted the 401k flows, right? Because that's part of the answer to the when, right? Is when these flows actually start moving in the opposite direction. That's where effectively it's the tide in the river, right? Yeah. When the tide shifts, my son used to do open water swimming, and I was a bad enough parent to put him into the Hudson at one point, right? So the
nasty.
Exactly, came out literally coated in black, but it stunted his growth. He's 6'7". But the Hudson is a brackish river, and that when the tide changes, it goes up or it goes down.
Yeah.
Right. And if you try to swim against that tide, you're not going to you're going to go backwards.
Yeah.
Right. So like trying to short aggressively in an environment in which the flows are still robust is really hard. We see that across share buybacks. We see that across the employment numbers, et cetera. It's one of the reasons why I'm so closely following the employment situation, because particularly as the white-collar workers start to lose their jobs, particularly as that starts to flow through, we should see a deterioration. Likewise, the baby boomers aging, as more and more funds are stuck into things like target date funds that mechanically reduce exposure as you age, this becomes an increasingly deterministic system.
This is how we weren't supposed to agree. Sometimes we disagree, and radically so. I don't know, radically, we just disagree.
Mostly about golf, but yeah. So.
Yeah, but I just said this is what happens in a recession. In a recession, you lose your job. In a depression, your boss loses his. So now you're like, we're really on the edge of that.
Yeah.
And the blackout period, by the end of the week on those buybacks, 92% of companies will be in their. So you get blackout periods.
Yep.
And we're about to enter this, the deepest, what we call the deepest part of the slowdown. Yep. And it's going to be really interesting to see, like, okay, if that's your tide, and this is the definitive quarter where it turns, and most importantly, at least from our nowcasts, it doesn't turn back the other way.
Yeah.
We have this nothingness on recovery when most position, these bubble caps were built on GDP going from -8 to plus 12.5.
Well,
we're going to 0, and we're going to be between 0 and 1 like Japan.
You see all this stuff. You see the actual. So if you read the headline complaints, it's people will say things like, "Well, the economy, the stock market can't slow, or the economy can't go into recession when nominal GDP is this high." Right? Well,
it can't.
It's really hard, but actually one of the points that I would make is that nominal GDP has decelerated dramatically, right? And it's going down even further and faster, and now suddenly you're starting to see, I have an expression like, why are you reading this now, right? Well, one of the headlines I saw today was on Twitter, Andrew O'Connell put out, credit card defaults are surging, and surging in particular amongst those in the 20 to 24 set, right? The younger generation is under increasing pressure, and you're actually seeing the realities finally set in of, it's not a great idea to pay for your groceries or your daily consumables at 30% interest rates on credit cards, because eventually you run out of your credit limit and you're spending all your money trying to pay that back, right? Now student loans are coming back on at the same time. We've seen unemployment begin to rise. This will inevitably start to hit individuals who, yes, they can afford their house under their current structure, but the minute they actually have to move, my God, they're looking at a tripling of their mortgages because they cannot, or they can't afford to move to get a new job because they can't give up their existing mortgage, right? And so there's all sorts of things that feel like they're really coming to a head. What scares me is the potential. Again, in 1987, I want to be very clear. I think that's hard, if not impossible, due to changes in market structure. But the idea that the economy can effectively come to a relatively sudden stop from what feels like a very robust position, I've almost never seen it look as having higher potential for that to occur.
Neither have I. So I guess the upside in our new business relationship is that I can get bearish enough. Thank you.
There you go. Hey, thank you so much. Really looking forward to it.
Yeah, and thanks to all of you for joining us. We appreciate it.